Hello everyone, welcome to the 143rd episode of me learning how to trade in Forex. So in the last episode we finished off the common trading mistakes part 3. So not cutting your losses, a running loss will be inevitable in the future. It's best to quit the trade before the situation worsens. Stay objective and don't rely on your instinct. Overexposure or underexposure, so keep in mind that the wider range of assets you decide to trade across, the more time and energy you will need to monitor the factors affecting each one. So maintain a balanced exposure to a range of assets without taking the care not to diversify too far so you're overwhelmed. Misunderstanding trends. A trend is a long-term direction a market is taking. Generally, this is determined by macroeconomic influences rather than individual political or economic events. So make sure you distinguish between the short-term and the long-term influences as these might not be aligned. Right, okay, so we've done that. We finished off the the associated lesson that goes along with it, I think. And now we're on to how spread betting and CFD trading work with what is spread betting. So let's get started then. What is spread betting? What is spread betting? Date is a 22nd. So what is spread betting? Like all forms of betting, spread betting involves putting up some money in the hope of getting more back in return. What makes spread betting unique is that the amount you win or lose keeps on growing the more right or wrong you are. When you spread bet, the degree to which you're right or wrong determines your profit or loss. When you spread bet, the degree to which you're right or wrong determines your profit or loss. To see how this works, let's start by considering a more traditional form of betting, like betting on horse racing. You might be used to seeing bet prices or odds such as 2 to 1 or 3 to 1, 2 or 3 to 1. This is known as fixed odds betting, because the amount you stand to win or lose is fixed according to the odds of your horse winning. If you bet £10 on red rum at 2 to 1 and red rum comes in first, you'll win £20 plus your original £10 stake back. So does that mean you win £30? Well, you end up with £30 overall then. If red rum doesn't win, you lose your £10 stake. Now what if you're betting not on whether red rum wins but on the time it takes for him to complete the race? You could do this as a spread bet, staking £1 for every second over 3 minutes that it takes for red rum to finish. This means if he goes on to run the race in 3 minutes 20 seconds, you would win £20, and for every additional second you would win another £1. However, the opposite is also true. If you're wrong and red rum finishes the race in less than 3 minutes, then for every second below 3 minutes you would lose £1. So if he finishes in say 2 minutes 40 seconds, you will lose £20, and for every second slower you would lose another £1. This winning or losing more according to the degree to which you're right is the essence of spread betting. So it's basically a more detailed version of betting then. Okay, so financial spread betting. While you can spread bet on sporting events and even on anything from results of elections to fluctuations in house prices, by far the largest market in the UK centres around finance and the value of financial assets. While you can spread bet on sporting events and even on anything from results of elections to fluctuations in house prices, by far the largest market in the UK centres around finance and the value of financial assets. These assets can be shares like Apple or BP, currencies like the Euro or USD, commodities such as gold, oil, sugar, stock indices that track the performance of a group of shares such as the FTSE 100 or Nikkei 225, other financial products such as interest rates, government bonds, options, etc. At any one time, each of these assets is worth a certain amount of money. This is its price or market value, and it changes over time. Today, one share of Apple might be worth $112, but tomorrow its value may have risen to $115. Similarly, €1 could be worth around 85p this week. In 2 months' time, it might have dropped to 80p. Financials, by far the largest. Okay, so financial spread betting is simply betting on how the value of a financial asset will change in the future. So financial spread betting is betting on how the value of a financial asset will change in the future. In most cases, you're betting on whether it will rise or fall. In most, so you'll be betting on whether the financial asset will rise or fall. The value. You're betting on whether the value of the financial asset will rise or fall. If you think the price of the asset will go up, you buy, also known as going long. If you think it will fall, you sell, also known as going short. If the price moves the way you anticipate, then your profit will continue to grow the further it goes. However, if the market moves against you, your loss will increase as the price movement becomes greater. Crucially, you need to physically own the underlying asset. You never need to physically own the underlying assets. For example, you could speculate on the price of oil without actually having to own any oil. And as you're just betting on the direction oil will take, profits can potentially be made from the price either rising or falling in the underlying market. You never need to physically own the financial asset. As a summary, spread betting involves speculating on an outcome, and the degree to which you're right or wrong determines the size of your profit or loss. Financial spread betting involves speculating on price of a financial instrument. The more the market moves in the direction you predict, the more your profit will grow. The more the market moves against you, the more your losses will increase. The more the market moves in the direction you predict, the more your profit will grow. The more the market moves against you, the more your losses will increase. If you believe a financial instrument's price is going to rise, you place a buy bet. This is known as going long. If you think its price is going to fall, you place a sell bet. This is known as going short or short selling. So if you believe the financial assets price is going to rise, you buy, you place a buy bet. Also known as going long. If you believe the financial assets price is going to fall, you place a sell bet, also known as going short. How does spread betting work? So, whenever you spread bet on something, you're presented with two numbers, the buy price and the sell price. If you want to bet on the price of a stock index like the FTSE 100, for example, you might see prices like this on your spread betting platform. If you thought the value of FTSE was likely to rise, you could buy at the higher price, also known as the offer price, of 6,500.5. If you expect the FTSE to fall, you could sell at the lower price, also known as the bid price, of 6,499.5. The gap between these two prices is called a spread, and this is what gives spread betting its name. This is basically just like normal Forex, isn't it? What is a spread? Neither the buy price nor the sell price represents the exact value of the financial asset you're betting on, also known as the underlying asset. Instead, the buy price is slightly higher than this value and the sell price is slightly lower. In the above example, the real world value of the FTSE would be halfway between the two prices at 6,500. The difference between the buy and the sell prices is just 1 in this instance, which is a spread of 1 point. whenever you're spread betting, whenever you spread bet on something, you're presented with two numbers, the buy price and the sell price. So if you wanted to bet on the price of a stock index like the FTSE 100, for example, we might see prices like this in a spread betting platform. So let's just do this. So if you think the value was likely to rise, you could buy at the higher price the offer price if you think the value was likely to fall. You could sell at the lower price, also known as a bid price. The gap between these 2 prices is called the spread. The gap between the higher price and the lower price is called the spread. This is what gives spread betting its name. Yep. What is the spread? Neither the buy price nor the sell price represents the exact value of the underlying asset you're betting on. Neither the buy or the sell price represents the exact value of the financial asset you're betting on. Instead, the buy price is slightly higher than this value and the sell price is slightly lower. The buy price is slightly higher. The sell price is slightly lower. In the above example, the real world value of the FTSE would be halfway between the two prices at 6,500. The difference between buy and sell prices is just 1 in this instance, which is a spread of 1 point. Because 6,505 minus 6,499.5 is 1. So how does the spread affect me? The spread is essentially a fee that your spread betting provider charges to place your bets. The spread is essentially a fee that your spread betting provider charges to place your bet. And the narrower the spread, the better it is for you. The narrower the spread, the better it is for you. Isn't it because we looked at this before, it's easier for you to make a profit as soon as the price starts moving, because the price doesn't have to move very far for you to make a profit. To close a bet, you need to take the opposite action when you opened it. So if you open a bet by buying, you close by selling, and vice versa. In our FTSE example above, if you buy at 6,500.5, You need to sell at the same price or higher when you close the bet, or you make a loss. This means the underlying FTSE price will have to rise by 1 point before you break even. So the size of the spread determines how far the market will have to move for your bet to become profitable. The size of the spread determines how far the market will have to move for your bet to become profitable. Bet sizes. When you spread bet, you make a certain amount of money on each point of movement in an asset's price. So when you spread bet, you stake a certain amount of money on each point of movement in an asset's price. For example, if a UK share moved 1 penny in the underlying assets, that's the equivalent of 1 point. Note that what constitutes a point can vary between different markets and providers. So, what constitutes a point can vary between different markets and providers. You can bet however much you want per point of movement, subject to your provider's minimum bet size. Your profit or loss is the difference in points between the opening and closing prices, multiplied by the amount you stake per point. For example, Steve believes that the oil company P's value is set to rise. Its shares are currently priced at £20 in the underlying market, and Steve's spread betting provider is offering oil company P at a spread of 1995 to 2005. UK shares are quoted in pence, so this is equivalent of a bid price of 19.95 and £20.05. Steve places a buy bet at the offer price of 2005, staking £5 per point. So Steve is hoping the price is going to rise because he placed a buy order. Rise. Yeah. A positive earnings forecast caused oil company P to surge to a market price of 2200. It's now quoted at 2195, 2205. Steve decides to close his position selling at 2195. The underlying market has moved 200 points from 2000 to 2200. However, Steve's profit is based on an 190 point movement from 2005 to 2195. This is due to the spread. As Steve bet £5 per point, his profit is calculated like this. £5 times 190 points is £950. Damn, Steve balling. Banking Group C is being quoted at a bid offer spread of 630, 632. You think the price of Banking Group C will rise, so place a buy bet at £10 per point. A week later, Banking Group C is now being offered at 618, 618. So you decide to sell and close your position. How much money have you made lost? Well, you definitely lost money because the value's gone down. So you placed a buy bet at £10 per point, and then so you need to sell it. This is the sell price, 618. So how many has it gone down? You bought it at 632, you sold it at 618. 32 minus 616, sorry. 32 minus 616. 32 minus 16, that's another 16, so it's dropped by 16 points. 16 points times £10 per point, £160 loss. The market moves 16 points against you between opening and closing, 632 minus 616, and you bet £10 per point. Yep. Cool. So lesson summary: when you spread bet, you're presented with a buy price and a sell price for each asset. The buy price is the higher price, also known as the offer price. The sell price is the lower price, also known as the bid price. The gap between the 2 points is the spread. The spread is wrapped around the underlying market price and represents a fee for your placing your bets. Spread betting involves staking an amount per point of movement in the price of an asset. Your profit or loss is the difference in points between your opening and closing prices multiplied by a stake per point. Your profit or loss is the difference points between your opening and closing prices multiplied by your stake per point. Bet types and costs. Bet types and costs. Date is the 22nd. All spread bets have a fixed time scale, which can be from 10 minutes up to several months or even theoretically years. So all spread bets have a fixed time scale. The fixed date and time when your bet will end is known as its expiry. The fixed date and time when your bet will end is known as the expiry. This is the maximum time until which you can hold your position. The expiry is the maximum time you can hold your position, although you can choose to close it before it expires. But you can choose to close it before it expires. Bet falls into two main categories based on their expiries. Fall into two main categories based on its their expires. Daily funded bets. Daily funded bets, which may be known by various names from different providers, will stay open for as long as you want. They are given a nominal expiry date at some distant point in the future, usually many years away, but you're free to close your position any time before this, whenever the market is open for trading. Daily funded bets. Will stay open for as long as you want. They are given a nominal expiry date in the future, but you're free to close your position at any time before this. Whenever the market is open for trading. If you want to keep a daily funded bet open overnight, most providers will charge you a fee for doing so. These are called financing costs or overnight funding charges. So for each day your position remains open, you'll have additional costs. This means daily funded bets are generally more used to speculate on short-term market movements only, because the daily overnight funding cost charges is going to stack up over time, and yeah, it's going to eat into your profits. So if you want to keep a daily funded bet open overnight, most providers will charge a fee for doing so. These are called financing costs or overnight funding charges. This means daily funded bets are usually used to speculate on short-term market movements only. Quarterly bets. Quarterly bets are bets that expire at a specific date before the end of a given quarter. Quarterly bets are bets that expire at a specified date before the end of a given quarter. However, just like a daily funded bet or digital hundreds, what's digital hundreds? You can close your position at any point before the expiry if the market is open. However, you can close the positions at any point before the expiry if the market is open. You can roll quarterly bets over into the following quarter if you let your provider know in advance, although there may be a charge for this. There probably will be a charge for this. You can roll quarterly bets into the following quarter if you let your provider know in advance. However, there may be charges for this. The cost of keeping a quarterly bet running to its expiry date is factored into its quoted price. This means the price for a quarterly bet will typically differ from the underlying market value, and the spreads on quarterly bets are often wider than daily funded bets. For this reason, they're generally used for longer term positions. So the costs of keeping a quarterly bet running to its expiry is often is factored into its quoted prices. Meaning the spreads on quarterly bets are often wider than the daily funded bets. Therefore, quarterly bets are generally used for longer term positions. The cost of spread betting, as well as the overnight funding charges mentioned above and the spreads we discussed in the last section, there are a few other costs associated with spread betting. These will apply whether you win or lose, although the amount you pay will vary to your provider and the dealing strategies you use. Alongside overnight funding charges and spreads, other costs associated with spread betting are betting whether you win or lose, are margin. Margin is the amount of money you need as a deposit into your account to open and maintain your positions, so it's a key factor in the affordability of spread betting. We explain how margin works in the orders, execution and leverage course. Different spread betting providers will require slightly different levels of margin. Our rates tend to vary across markets according to the underlying asset conditions. While you have a bet open, your margin payment is assigned to it and can't be used for anything else. However, this money is released as soon as you close position. Right, so it's a key factor in the affordability of spread betting. We'll explain how margin works. Yep. So different spread betting providers offer slightly different levels of margin, and rates tend to vary across markets according to the underlying conditions. Margin is the amount of money you need as deposit in your account to open and maintain your positions. So this is the same as the Forex stuff basically. While you have a bet open, your margin payment is assigned to it and it can't be used for anything else. The margin is released as soon as you close the position. Currency conversion fees. When you place a spread bet, it will be denominated in a particular currency. More often than not, this will be in pounds, e.g. £10 per point, which would usually be the base currency of your account. If, however, you are able to place a bet in a currency other than your base, you may need to pay an associated conversion fee. For instance, many spread betting providers give you the option of betting on US shares in US dollars per point. In these cases, before your account can be credited or debited with any profit or loss, the dollar figure needs to be converted back into pounds, which may incur a fee. More often than not, it's in pounds. If you're placing a bet in a currency other than your base currency, you may need to pay an associated conversion fee. Extra charges. Lastly, you may find that your spread betting activity or lack of it incurs some other fees, such as extra charges. Controlled risk premiums. There's a lot of extra stuff taking your profit away from this. As spread bets can be subject to slippage, you may be able to protect yourself against this risk by paying a small extra fee for a guaranteed stop. Explained in the orders execution and leverage course, some providers waive this fee if the stop isn't triggered. Some providers waive this fee if the stop isn't triggered. So if it doesn't work, so even if you do place a guarantee stop, and if the price still has not, if the guarantee stop still hasn't worked on the price action, then the provider will waive the guarantee stop fee away as the stop isn't triggered. But in the end, you're still not where you want to be because the price has gone past your stop. So, yeah. Okay, cool. Provider waives the guarantee stop fee that they were meant to provide. But okay, never mind. So controlled risk premiums. Spread bets can be subjected to slippage. So you can protect yourself against this risk by paying a small fee for a guaranteed stop. Feature subscription. Your provider may also pass on the cost of providing certain platform features, e.g. advanced charting packages, live prices, although they may be willing to provide a rebate for more valuable customers. Your provider may also charge for extra platform features. Your provider may also pass on the cost of providing certain platform features. Your provider may also charge for extra platform features. Yep. So, that's in summary. There are two main types of bet: daily funded and quarterly. Daily funded bets are usually used for short-term positions, and funding charges apply if you hold the bet overnight. Quarterly bets are generally used for longer-term positions, and the cost of running bet to expiry date is factored into the quote price. The other costs of spread betting include spreads, margin, currency conversion fees, controlled risk premiums, and feature subscriptions. Yeah, okay. So why do people spread bet? People actually, I think from the last, there was one that I didn't really get. Currency conversion, extra charges, quarterly. As well as overnight funding, the spreads we discussed lower. Social spread betting. So these apply whether you win or lose. Although the amount you pay according to your provider and what's dealing strategies? Dealing strategies you use. Margin is the key amount of money. Yep. Dealing. So whether you win or lose. However, this money is released as soon conversion, currency conversion, extra charges, controlled risk premiums, feature subscriptions, private rebate for valuable customers. Yep, okay, I don't think I missed anything then. Okay, so is there enough time to not really, but I'm just going to skim through this. Why do people spread bets? Tax-free profits, no commission, capitalizing on falling markets, thousands of markets, 24-hour dealing, leverage. Oh, this is the. With conventional trading, you generally need to pay the full purchase price of an asset up front. Spread betting, however, is a leverage product. Conventional trading, you can still use leverage in conventional trading, can't you? Yeah, you can still leverage using in normal trades. I don't know why it says you need to pay the full purchase price of an asset up front. The risk of using leverage, yep. Leverage can work to your advantage when you spread bet. However, it's important to remember that both profits and losses are based on the full size of your bet. This means they could far outweigh the risk of your initial deposit. So leverage is the benefit of spread betting, but also its biggest risk. Yeah. Okay, cool. I'm going to leave that for the next lesson though. So thank you all for watching. As I said before, in the next video we're going to go through why do people spread bet. So yeah, see you guys. Bye bye.